are tariffs inflationary? Because we had a trade war tap dance in 2018 and 19, and the growth rate of inflation fell. Tariffs are taxes. They're one-time price adjustments. And then if you get in a trade war, it actually becomes disinflationary because the economy gets hit.
Hi there, this is Jess Uphoff with This Jess'd In. I'm here with my co-host, Elise Santani, and we have the lead analyst for Housing Wire, Logan Mohtashami. We are so excited to talk with you today, Logan. What in the world is going on with the housing market as it relates to, we've got high inflation. I know you said labor over inflation. We've got all kinds of factors going on right now, tariffs. Let's get into it. Give us your opinion on what's going to happen in 2025 in the housing market.
So oddly enough, the worst in the housing market is over for a bunch of different variables here. Number one, the housing market wasn't in a good place toward the end of 2020, 2021, and early 2022 because active inventory fell to levels that I thought were savagely unhealthy. Active inventory is up because it doesn't benefit anyone in the housing market when inventory got that low because prices escalate out of control. When prices escalate out of control, it takes forward demand away. So that I thought it's a positive for 2025. Just to give everyone some perspective with our data lines, in March of 2022, active inventory got to 240,000 for the entire country.
Wow.
We're a country of over 342 million, with 162 million people. We only had 240,000 active homes available for sale. So the multiple bids and the price inflation that we saw wasn't very good. Rates then escalated out of control in 2022 in the fastest fashion in history. So home sales crashed and has been staying at record low levels, adjusting to the workforce. But they found a bottom. Active inventory has risen. We're not back to normal, but we're somewhere in a better area where price growth is cooling down. So as every year goes by, wages grow, household formations grows, dual household incomes grow. We have near 5 million total home sales in 2023 and 2024. So rates just heading down towards 6% can boost housing demand a couple 100,000. And you can grow sale. The problem is getting rates down towards 6% and staying there. For me, I thought it'd be more difficult because I believe the Fed is, focusing on the labor market more than inflation. The growth rate of inflation is falling a lot, like 9% CPI down to 3%. PCE inflation went from 7% down to 2%. But we're in a later stage of the economic cycle where the Fed has already cut rates. That's another positive. We're already in a rate cut cycle. The mortgage spread, which is something that's not common for everyone. I always say there's a relationship with the 10-year yield and 30-year mortgage rates since 1971. It's a romantic love slow dance partners. They've been dancing together. 65 to 75% of where the 10-year yield and mortgage rates go really is Fed policy. But the mortgage spreads is the difference between the 10-year yield and 30-year mortgage rates, and it got up to 3%. Normally it's 1.6 to 1.8%. But the spreads have improved in 2024 and in 2025 like they should have. So we have a Fed rate cut cycle. We have better mortgage spreads. Sales have kind of bottomed around this 4 million level. Inventory is rising. Price growth is cooling down. All these things are positives. These are things we didn't have in the previous year. So as mortgage rates head down towards 6%, you can grow sales. Price growth will be pretty tame in 2025. And it looks like a normal year. And in that context, I'm very happy to see what's going on in 2025. I wasn't happy seeing what was happening toward the end of 2020, 2021, and 2022, because when you have price inflation like that, because active inventory is too low, that is not a good thing. But now we're in a much more balanced housing market going into the spring of 2025.
Can we talk about COVID? Because right before we started the show, you had predicted, it sounds like, that the economy would rebound within like 5 or 6 weeks, is what you said. Why did we keep the federal funds rate at 0 for 2 years straight? Like, what was the decision behind that?
So this is an interesting concept because in February of 2021, I wrote an article, "We need higher mortgage rates." The Federal Reserve does not revolve its dual mandate around the housing market. So what happened in 2021 is that there was a lot of people who didn't believe that the recovery was happening. I retired my COVID-19 recovery model December 9th, so I was already well ahead of everyone else. But the unemployment rate was still above 6%. And a lot of people just still weren't sure about COVID, about what can or can't happen. So the Fed just basically let it ride out there, and they don't really they wouldn't come out and say we need to push mortgage rates or the Fed funds rate higher to get mortgage rates up because we believe the housing market is overheating. Because the unemployment rate was still above 6%, they kind of did not want to even go into that. And then eventually the growth rate of inflation, the history of global pandemics, they're all inflationary, right? We had very stable inflation throughout the century. We had zero interest rate policy, QE1, 2. We couldn't get inflation above 3% if we tried. But global pandemics, very inflationary. And then the disinflation happens. And honestly, the Fed didn't have to even do the last 1.5% rate hikes. The growth rate of inflation was falling already, like it does in all global pandemics. And we're just basically here. So considering how doomsday everyone was and the COVID-19 recovery model that we talked about before we came on here, I wrote that on April 7th, 2020, saying, hey, listen, we're going to recover this year. The housing market will be back in 5 to 6 weeks. Because if everyone is going to be alive and we plug the holes with people that are unemployed, we had 30 million people unemployed. Most of them were renters, and then 5 million in forbearance. But we still had 133 million people still working. And with 3% mortgage rates, behavior had to change. And then once it did, we had the fastest recovery in home sales ever recorded in history. So it's everyone's first global pandemic. So it's going to be crazy on the data line side. We saw data move in a fashion that we never thought was, humanly possible. So I could get the whiplash theory on not understanding what's going on there because it was pretty crazy. I mean, it's been a pretty crazy fourth going into 5 years now after 2020. So for a nerd like me, it's exhilarating because we get to see how do we test our models in the most chaotic time in history. But for housing, it was just one of these things where authentically, for the first time in history, we got to levels that were just not good. I mean, we had I think 86.7% of the homes in America in early part of 2022 had multiple bids. And we're not talking like 5 or 6 or 7. We're talking 30, 40, 50. I remember seeing a house in Los Angeles. There's 247 people in line. It wasn't even a good house. We just had too many people chasing too few homes, which like the housing bubble years was a massive credit boom and sales boom. But here it was just completely different. It was actually an authentic shortage. And then rates went up. Home sales came down. Prices actually did authentically decline in the second half of 2022, but then everything kind of stabilized around the 4 million level. And the housing market is working itself back to normal.
What is the interest rate that will get sellers off the fence to sell? Like you said, we need to approach a 6% rate. Is that the inflection point, or is it sub 6? You think that
the builders have been able to grow sales and keep sale levels at 2019 levels with a sub 6% mortgage market. I've only seen the housing market grow sales or get better when mortgage rates go from 6.64 down towards 6%. And it's worked 2 times. There's a seasonal demand that happens at the end of the year getting ready for spring. But if I take that out of the equation, 6.64, we're almost there. To 6%, we get positive weekly demand, like multiple weeks of forward demand getting better. And we have to remember, we are literally talking about the lowest levels of sales ever, right? So it doesn't take much to move the needle. But even with 6 to 8% mortgage rates and where home prices are right now, we still have near 5 million total home sales in America. In the last decade, the peak was around near 6 million. So we're missing a roughly like 400 to 800,000 home sales to be somewhat normal, but a million mortgage buyers just to get back to the levels of the last decade.
interesting?
Wow. So we're in the first quarter of 2025. Trump's our president. We have a tariff. We don't have a tariff. We have a tariff.
Tariffs on, tariffs off.
Yes, everything is changing at a radical speed. How should people plan? Like, what do you think is going to happen, and how do you think it's going so far?
So when we do the tariff on, tariff off, I thought about the Karate Kid. and it's been a big part of my work actually when Trump was president first about, what I call as a trade war tap dance. Like if you authentically believed in tariffs, you would literally put them day one and you never take them off. Like it's going to take many, many years for tariffs to kind of work yourself if you're going to bring, production back home, and then you have to deal with a trade war. So I've always looked at it as a trade war tap dance. Back when President Trump first won, he didn't go into the trade war until the third year of his presidency. He waited until the corporate tax cuts were in place because he knew that he needed, corporations to kind of go along with him. And even with that, and inflation, the growth rate of inflation actually was heading lower in 2018 and 19. The markets were all over the place. The stock markets fell, business investment went down to zero. Companies didn't know what to do with the trade war. So we are going into that right away this time in his second presidency. So there's a lot of tariffs on, and then he takes them off, and then he puts them on again. And then this morning, he's going to do double the tariffs on Canada. This is just kind of how he operates. It becomes more problematic if this keeps on back and forth because businesses just don't know what to do until something is clear. And that's the concern. The concern was last time he had a very good backdrop to try to do this, and business investment still went to zero. Now it's a little bit different. But for housing, you could clearly see the White House wants lower mortgage rates, right? They are full blown into talking about this. And before the year started, I've run these economic cycle models for like centuries. And what happens typically is before every recession in the US, residential construction workers lose their jobs, right? Rates get too restrictive, housing starts fall, permits fall, and then residential construction workers lose their job. Then the recession happens. So we're getting to that stage to where, okay, this becomes more problematic for the private sector if rates keep on going higher. So right after Trump won, his former secretary, Treasurer Mnuchin, was like, we would like to have a cap on the 10-year yield at 4.5%. So right there was like my cue, like, oh, they really want mortgage rates to go lower. So at first, no one kind of believed it, but then Bassett's like, yeah, we want mortgage rates to go lower. It makes their game plan much easier if the 10-year yield falls. And I personally believe like their internal surveys showed them that the housing market is much bigger to the public than the Federal Reserve acknowledges. And you could see this with local governors as well. Florida's talking about banning property taxes. Other states are going to have to probably get into that if that happens. So there's a huge housing play with Trump's presidency. But they think if you get mortgage rates down to 6% or even lower, people buy homes. That's a positive for them that they could spend that's something we did. That's why you see a little bit more aggressive push by the White House, there's Treasury Secretary, on getting the 10-year yield lower for mortgage rates to go down.
How do you push the 10-year yield down when you're implementing tariffs, though? Tariffs are inflationary, right? So
this
those two things go against each other.
Yeah, this is the thing. Are tariffs inflationary? Because we had a trade war tap dance in 2018 and 19, and the growth rate of inflation fell. Tariffs are taxes. They're one-time price adjustments. And then if you get in a trade war, it actually becomes disinflationary because the economy gets hit. So an easy way for me to explain this is that last time when we did this, the things that were put on tariffs, those prices, dishwashers, whatever, stuff like that, those prices actually went up. But the total items that we see in the CPI inflation number and the PCE inflation number, that didn't take off. That actually went lower. So back then, even with the trade war tap dance, we didn't see inflation take off. We haven't had high percentage of tariffs for like 80 years. So I just think that's in a consumption-based economy, it's a little bit more problematic if you keep them there for a long time, because then the other country does a tariff out there. And also remember, like for CPI inflation, 45% of that index is rent, shelter. So the tariffs don't really impact that as much. But as you can see, the markets are starting to like act up. And this is similar to what happened in 2018 and 19. So tariffs are taxes, one-time hits on pricing. But if you spread them out, right? If you more and more products, and then you get a trade war coming back and forth, that's where it can become problematic. But we didn't see inflation go higher in 2018 and 19. Actually, the growth rate slow down. And of course, if the economy weakens, like in the 30s with higher tariffs, it's not, in a sense, inflationary. It's a very confusing topic because everybody assumes that all inflation data is going to take off, but it really is the scale of products. And then, of course, the PC inflation is like 16 to 18% of that is shelter. But for CPI, the big tamale is rent. And the growth rate of rent has slowed down enough. We get more supply coming out to the marketplace. That number is really what the Federal Reserve is counting on keeping inflation tame.
Well, first, I just want to say thank you for admitting that this is very confusing because you justified my internal thoughts.
No, it is. I literally have like no life. All I do is look at data all day. So for me, it's like exciting, but I also have to remember that people are normal. And people
Yeah.
don't spend their entire lives looking at data and models and all that stuff. So the confusion
Yeah.
is, it really since COVID, right? Since 2020, the last decade was so boring. Like I used to be a high school basketball coach in the last century. And I remember one time telling my assistant coach, God, we're just, it'd be fun to have one season where the games were close. And then the next
Yeah.
season, every game like lasted in the last seconds. And I told that coach, never let me say that ever again. And the last decade was very slow and stable, and economic data was easy to model out. Man, it is just crazy. There's no normal years. And with social media and the amplification, like one of the things I try to do is, unfortunately, housing became this very professional grifting area for YouTube, TikToks, and we got a bunch of untrained professional grifters who are not housing analysts who keep on talking about home prices crashing and everything. I thought one of the things that I have to do in this century is that you have to engage these people into live debates and then show people, like if you can teach people economics and they can read and understand, then all those crazy people kind of go to the side because they don't forecast, they don't have working models. So that's the kind of approach I had, because I think if I can teach it and get people to understand it and make it fun, right? Unfortunately, my fellow economists are stiffs and they're really boring and they're just they're not engageable. So we have this nerd tour and I try to make these live presentations fun so then people could come to Instagram. Like we have 500,000 people come to Instagram stories because I literally do live videos daily and try to explain everything, because if you don't follow this stuff, it has to be more confusing than ever.
Yes. And so that's, I guess, kind of my question too. So if you are a real estate agent or if you are in the market to buy a house, you're confused. What are we doing? Do we wait for rates to fall? Do we buy right now? Do we pay to buy down the rate? Do we buy it now, refinance it later? What's the move?
So I always say this: housing is the cost of shelter to your own capacity to own the debt. Millions and millions of people buy homes every year. And it doesn't change, right? Because housing is it's also a lifestyle. Like in the last decade, I had this skit I do. We're not complicated people. We rent, we date, we mate, we get married 3.5 years after marriage, we have kids, we buy single family homes. We've been doing this post World War II all the time. So for consumers, you have to realize I always say this: the total cost of housing, if you get that payment, if it's good for you and you are the only one who knows your own financials better than any bank or anybody else, then millions of people like you buy homes each year. If you're not ready, then you're not ready. But the marketplace doesn't wait for you, right? And one of the things that I've realized is that not a lot of people know this. It's really rare in America after post-World War II for home prices to fall. Like I show these data line charts and I say, if I take 2007 and 11 out of the equation, the only year that home prices fell was 1990, and it was by 1%. That was mostly because of Southern California, right? The housing bubble crash years has ruined the kind of structural housing economic discussion, because that was a credit boom, credit bust, forced credit sellers, underwater mortgages, and that whole marketplace changed after 2010 in qualified mortgage. So now people always go, why are these people buying homes? Because they can afford it. and it's a lifestyle. And once you, like, the best hedge against inflation on planet Earth is the American 30-year fixed mortgage. I'm telling you, my counterparts in other countries hate us, right? In Canada, they're doing 90-year loan modifications now because they're tied to short-term rates. Here, you buy a house, that debt cost is fixed, wages rise every single year. Homeowners on paper have never looked better, ever.
Yeah.
Like, I show these on my live nerd tour. I go, let's look at the FICO scores of American households. Never been better, right? Its majority is 720 and over. 40% of homes in America don't have a mortgage. The loan to value of homes right now is 46.6. We have $38 trillion of nested equity on top of a $52 trillion housing market, right? Maybe Cleopatra in her prime, adjusting to inflation, had more wealth than the US, but American homeowners have never looked better. Why? They buy a house, that debt cost stays the same, their wages rise. Like, the whole system is rigged for housing just for this, right? And as your wages rise, you have more disposable income, your lifestyle becomes better. That's why homeowners in America have done great. That's why the whole COVID-19, everybody thought home prices were going to crash, Americans were going to rush. I had this thing that was like, if you all remember forbearance, right? People made forbearance as like their big home price crash thing in 2020. I was like, what are you talking about? Like, everyone that made $60,000 a year and plus got their jobs back in October 2020. People aren't going to give up their low total housing costs to rent, and that's what happened. And unfortunately, though, inventory got to such a really bad level that I don't know if you remember the game Hungry Hungry Hippos in the 1980s. Yeah, well, that was the housing market, except we had all these hippos in one ball, and it was not a good thing, and prices escalated. But oddly enough, we've had other decades, like in the 1940s, home prices grew faster then. I always tell people, do you realize that in 1977 and 1979, home prices grew faster then than 2020 and 2022? People don't believe me.
Wow.
Because mortgage rates were much higher then. I said, oh, here it is, because home prices typically move with inflation. 40s had inflation, 70s had inflation, pandemic inflation. Housing bubble years, no. Housing bubble years was unhealthy, credit boom, credit bust, inflation wasn't moving with it. The wages couldn't support that housing. But that marketplace is over. That it's all done. We fixed that, and we're just here. So I think general consumers, when they're ready to buy, they buy. They bought in 2008, they bought in COVID, they're buying this year. So you have to make sure that you are comfortable with that total payment, because once you're in, debt cost stays the same. Wages rise.
But if you're going to buy a house today and you're at, what's your rate today?
Mid sixes.
Do you just lock in? Do you think it's smart to buy your rate down?
To me, this is an internal discussion with every homeowner, like what they need to do, because of qualified mortgage, you can't really leverage yourself on that house payment. I mean, housing is, the rate variable is just one. It's the total cost of housing: principal, interest, taxes, insurance. So the rate variable that you might have a decision on, you ask yourself, can I sleep with that payment and wake up with it every morning and be comfortable? That's how I look at it. And if I can, I have no problem. I'm buying the house, because millions of people are doing that, right? So that rate level can influence the payment to a degree. But again, purchase price, taxes, insurance, how much you put down, there's all these components into it. But if you can control the rate, if you can sleep with that payment, you're good. And that's what's happened post World War II with millions of people in America. They buy that house and they start their lives. They go to work, they take their kids to school, stuff like that. But that payment has to be pretty good for you and your own financials. You know yourself better than a bank. So let the numbers answer that question to you. If you need to buy the rate down, fine. But if you feel like you can't do this, or you're stretching yourself, then you go with that. But we're going to get near 5 million total home sales again this year, right? There's just groups of people. And I always say that one of my running jokes is that, how many people here were told BlackRock bought all the homes? And people raise their hands. Well, BlackRock has bought 0 homes. Blackstone owns 0.6%. Guess who the villains of the housing market were always? Was the millennials. They were the biggest percentage of home buyers for like 12, 13 years. They only lost it in 2022 for 1 year compared to the baby boomers. The millennials are buying. Why? Because housing is just a function of cost of shelter, starting your life, your family, your kids, your work. And that's what it was about. And that total payment has to make sense for you. You can
Yeah.
control the rate variable on that.
Logan, I have a question. The average rate between 2010 and 2022 was somewhere at or below 4%, right? For that
Three and
12
a
years.
quarter to 5% was the range for that decade.
Okay. Okay. I read an article that entire period from 2010 to 2022, there was quantitative easing or mortgage-backed securities purchasing by the Federal Reserve. Is that a true statement?
It is, but
For that
the
12 years?
MBS, the mortgage-backed securities is just helps the spread. There's a lot of articles that say that, and it's actually not true. It's Fed policy. Fed policy was that zero interest rate policy, and the global bond market, we had trillions of dollars that were negative yields. So the mortgage-backed security helps the spreads. Usually the spreads is between 1.6 to 1.8. It got as high as 3% recently. So you're talking about that market is controls maybe 1 to 1.25% of rates. But generally speaking, 65 to 75% of where mortgage rates at the 10-year yield goes is Fed policy. So we had zero interest rate policy that period, but also the world was at zero interest rate policy. The growth rate of inflation was in fact, the growth rate of inflation half the time never hit the 2% target. So that was a very unique period. The recovery was weak, wage growth was weak, so we didn't have that. But the mortgage-backed securities is about 1 to 1.25% difference out here. And this is like, for example, a lot of people thought that rates can never go lower because the Fed is never in the mortgage-backed security market. The 10-year yield goes down, rates go down, but the spreads are getting better, right? Right. And as the spreads get better, it gives you a better chance to get down toward that 6% level. Like we never would have hit 6% mortgage rates last year if the mortgage spreads didn't improve. And that shocked a lot of people because a lot of people thought spreads were going to get worse and worse. They didn't. And if you look back at mortgage-backed securities going back to the 1970s, yes, this is what I do with my life. You typically have periods of times where the spreads get worse, it gets bad. But the Federal Reserve really got into the mortgage-backed security market there because housing was depressed in sales and they wanted that to recover. But you're looking at just 1.25 at peak difference in mortgage rates there.
So we could see rates in the fours again at some point. They weren't all artificially created. Like
No,
it was
no.
okay.
For rates to get to break under 5%, you would need the Fed funds rate to head down toward 2%. You're going to need softness in the economy, and the spreads kind of compress on themselves. Now, getting to like 3.25 to 4.25 and have it stay there, you're going to need zero interest rate policy for something like that, and you need global Federal Reserves to work with that. But like I can't forecast below 5.75% in the last few years just because of where Fed policy is, but we're heading toward a direction to where you can get rates low enough where you can grow sales. A lot of people thought we can't ever grow sales unless rates are in 3s, 4s, and 5s. That's not the case. You could just get down towards 6 and stay there. Because we're working from such record low levels, it doesn't take much to move the needle. But if the economy starts to get weaker, the labor market gets weaker, spreads compress more, 10-year yield goes down, Fed funds rate goes down, low 5s to high 4s are definitely in the playbook because the spreads have been bad for a very long time, but they're slowly getting better.
And you've been talking about this on podcasts and in your articles about how we are starting to see the weakening of the economy, right? So this
Well,
is the
we're seeing softness. To me, it's like the labor market has to break for the Fed to pivot. That's my thing since 2022. This is where I get really geeky and nerdy. The Federal Reserve had like a policy where we would like the Fed funds rate to match 3, 6, 12-month PCE. I'm like, wow, that's great for housing. That means the growth rate of inflation is going to fall in 2023. That'll be good. And then somebody spiked the Fed's eggnog. Well, I'm going to find out who did that because that ruined everything. Then the Fed just said, oh, no, we're going to change everything. And I was like, okay, they're focusing on the labor market. And how do I prove this is that I show people the growth rate of inflation fell faster than the Fed's forecast in 2023, but the labor market outperformed. So the Fed was like, oh, we're still staying hawkish. So a lot of people were confused about that because they were told, well, the growth rate of inflation falls, so should rates. No, they focused on the labor market. So there's things that we track right now, and the cheat code that I always say for economic cycles is traditionally residential construction workers lose their job first. So the supply for the builders is picking up. Housing permits are at recession levels. Rates being elevated means they're going to start laying off people. When that occurs, that's the front line of every recession in recent history. Take COVID out of the equation. And then the 10-year yield can fall and mortgage rates could fall. So that's where I'm was focused on. And then all this other stuff happened. We're firing people, we're trade war, we're doing all this stuff. So you have a lot of variables now coming in together. But I could see why the White House wanted the 10-year yield to go lower. Like, to me, if the 10-year yield breaks under 380 and starts heading lower, the bond market is sniffing a recession. So we're obviously lower. A lot of people thought, well, with the trade war and tariffs, the 10-year yield is going to go up, and 8% mortgage. It doesn't kind of work that way. But here, we just keep an eye on this, like I'm an economic cycle person first, housing second. So we track cycle work. So we're keeping an eye on to see what happens. A good example, Delta just warned. They said consumers are spending less, corporations are spending less. I think American Airlines said they lost 75% of their government flying people. So there's things that happen when you withdraw money from the economy. Less dollars are being spent. And with that and the trade war and rates where they are, is that enough to push it to recession? We have recession models. I have not had my recession triggers be targeted yet, but we keep an eye on that because that matters for mortgage rates. Housing tends to outperform, of course, when the economy is softer because rates go down lower.
Do you think in 2025 at any point we will see a rate in the fives?
In the fives, you can get there easier now than last year. I think we got down to 6.08%. So you can see the high fives, like 5.75 is the bottom end of my forecast. And that's just getting the 10-year yield down to 380, which we've been able to do 2 other times. So that's not that, but it does need economic data getting weaker and softer and perceived weakness. And we see the 10-year yield is like got to 419, 420 this morning. That's not that far off from my bottom end forecast. So like 380 is my forecast there. You can get high fives in that nature. But again, economic data runs that. So every week, all these data lines that we track, we talk about in our podcast, I show every day on Instagram. If they start to break, that means rates could go lower and stay lower. What's happened in the past is people think the US is going into recession and it's not, and then rates just shoot right back up. So there are models for this that we focus on, but if the labor market starts to break, that means rates could stay lower for a longer period of times, and duration matters so much for housing.
Would you consider 2025 a year of a stagflation?
Stagflation is something that happened in the late 70s. And if you need stagflation, you need unbelievable wage growth and economic growth, and oil prices had a shock back then. Adjusting to inflation, oil prices have to get to $450 to hit what we saw in the 70s. If you want to make a condensed stagflation argument, that would basically mean that the economy stays firm. It doesn't go into a recession, wages stay firm, and prices tick up a little bit higher. In that context, you can make maybe a stagflation. But what we saw in the 70s and back then was we had major labor force growth, major economic growth, and then we had an oil shock as well. So I try to model that out. I don't see how we get the stagflation in the 70s here because the consumption base of the economy would lower that. That means prices can't stay as firm as they run. So I'm not a stagflation 70s person, but if you want to make a condensed version of it, that's something out there. The 70s was very rare in history, not just for the millennials. I mean, the housing was booming in the 70s, right? Shelter was booming, home sales were booming, home prices were booming, wages were booming, but we also had an oil shock. And what that means is if inflation ticks up, wages have to tick up with it. Wage growth is firming up the last few months, but it's hard to reaccelerate that if consumption doesn't stay through.
Logan, you are so knowledgeable and so passionate about what you do. Thank you for being with us this morning and sharing your insights about what's happening in the economy and the real estate market. We really appreciate it. It was nice to spend time with you today.
Yeah, it's great to be here. I always have a few sayings. Economics done right should be very boring. It's not designed to be this fun, sexy thing. So be careful of who you listen to out there. And you always want to be the detective, not the troll. So if you let social media amplify your mind, you could get completely lost. And this is why I am here. I literally think I was born just for this period of time and just try to make sense of it and try to make it as entertaining as possible. So we have a top 10 business news podcast. We could come on 3 times a week. You could find me on Instagram, and my names. Our tracker articles are very popular with real estate agents, investors, and Wall Street, because we give our data is fresh up to the week, so we're like well ahead of the curve. And just to give you guys one quick story, Mike Simonson, the president of Altos Research, him and I work together. It's not fair that him and I work together. We're talking Batman and Robin nerd duo. He actually warned Lehman Brothers about the housing market in 2007. He told them that we track housing a little bit differently, and we think this is breaking. And Lehman Brothers told them, you know what? We have 85 analysts. We're good. They didn't listen. Mike walked 15 feet down in the conference room, saw Goldman Sachs. Goldman Sachs took the information, shorted the housing market, made 10 billion. Lehman went under. We believe we are the most prolific housing data trackers on planet Earth. We are not shy about it. We would love to debate everybody and get everyone's models out there. And we have a lot of passion and fun with it.
You can tell. Well, thanks for being with us, Logan. It was nice to see you. Have a great day.
Pleasure.
Thank you so much.
Bye-bye.